The Federal Reserve just dropped the hammer on the 2026 market rally. If you're betting on a pivot today, you just got a wake-up call. The March FOMC meeting, it's concluded, and the Fed rate's decision is they're on hold. They're going to stay at 3.5% to 3.75%. The market's already reacting, and it's not pretty. Why do they stay paused, despite the pressure? And more importantly, is the promised Fed rates cut officially dead for 2026? Let's take a look at the numbers. The meat. This wasn't even close. An 11-1 vote confirms the Fed is unified. While the world was looking for a Fed Reserve update that leaned dovish, Chair Powell stayed firm. The culprit? Persistent inflation. Current Fed rates are staying put because core PCE, it's stuck at 2.7%. What is PCE? Personal consumption expenditures. Is a measure of inflation that tracks changes in price of goods and services consumed by households. It's excluding the more volatile categories of food and energy. This exclusion helps provide a clearer view for underlying inflation trends. All right, you may be thinking, what is the importance of core PCE? Core PCE is the Federal Reserve's preferred gauge for assessing inflationary pressures. It influences monetary policy decisions, including interest rate adjustments. By focusing on core PCE, policymakers can better understand stable inflation trends, which are crucial for economic forecasting. Current trends, as of January 2026, the annual change in core PCE price index rose to 3.1%. That's up from 3% in December of 2025. This increase marks the highest level in 2 years. The Federal Reserve typically aims for a long-term inflation target of around 2%. The meat, the X factor is the Middle East. The ongoing Iran conflict has sent oil prices skyrocketing. And you guys might have seen that already at the gas pump. We're going to take a beating for a little while. It's leaking to every part of the economy. Energy costs are the sticky inflation the Fed can't ignore. As long as oil is volatile, the interest rates aren't coming down significantly. We have to talk about the higher for longer reality. For 2 years now, we've heard it, but now we're living it. Fed rates news today confirms the central bank is more afraid of an inflation rebound than a cooling economy. Investors who were positioned for cheap money, they're scrambling now. If you're looking at Fed rates today, you need to realize that the neutral rate is likely shifted higher than we thought in 2024. The prediction? So when is the Fed rates cut? The 2026 dot plot, the Fed's own forecast, it shows one cut is still on the table for this year. But here's the catch. The timing is data dependent, which is the Fed's way of saying they don't know. Most analysts are now pushing that expectation to December 2026, or possibly even further, Q1 of 2027, if energy prices don't stabilize. The summary, this Fed Reserve update tells us that the war on inflation isn't over. A cautious strategy would be to move away from high leverage growth and towards cash flow heavy assets that can handle the current Fed rates. As Stone Cold Steve Austin would say, and that's the bottom line. Stay tuned to my channel. I'll be tracking the April jobs report to see if the Fed's hand is forced. And hit that like button if this helped you make sense of today's Fed rates meeting. It really helps my channel. Leave a comment. Share your thoughts on the decision. I appreciate your time. I'll see you soon.